Punita Kumar Sinha, managing partner with Pacific Paradigm Advisor, joins us. Let's take our conversation with her forward. Punita, good morning. Thank you for joining us. For a market which was gliding, for a market which was chugging along very smartly, a lot has changed in last 2 weeks. Selling an Adani group of companies, uh, concerns around macro, and if that was not enough, suddenly brokerages are calling this market expensive when they feel that Indian markets are trading above their mean average, which means it needs to correct. Is there a change in the market mood and the momentum?
I wouldn't say there's a structural change. There may be short-term change because structurally, I think India still looks very good from a long-term perspective, from a macro stability perspective. Of course, we have two big events this week. So any predictions that one makes right now can easily be negated by anything that happens in the budget on the first or with the Fed. So it's really hard to make a prediction at a time when we have such big events that are going to set the course for the next several months of market performance. But in general, I would say that if you look at debt to GDP, if you look at inflation, if you look at real rates, India is actually looking pretty good compared to the other markets. But yes, on valuations, India is looking expensive. Um, Firstly, because India has outperformed last year, and it is trading at higher. It's trading at a higher premium than historic averages, both to emerging markets and to the rest of the world.
Okay. Uh, there are two scenarios which are coming up ahead of the budget, purely from a market standpoint, and that's all about taxes. I'll construct both the cases. First, what if the underlying tax structure for LTCG and STCGs change? What happens to market in that scenario? Second scenario, the rates are not changed, the tenure is changed. So what happens to market in the second scenario?
So, I mean, I think, of course, from an LTCG perspective or any short term tax perspective, if there is any rise, then obviously that would impact the market negatively in the short term. Not because it is a wrong move, because the rest of the world short term is taxed at the income tax rate. So India is actually lower than that right now. So if they want to rationalize it to global peers, then it wouldn't be a wrong move. But the markets obviously are not going to like it. And then the same thing for the long-term capital gains as well. Nobody in India likes to pay taxes. And versus Asia, India's tax regime isn't great. But versus developed markets, Europe, US, India's tax rates are pretty benign.
Okay. So what has been your fund philosophy, and what has been your positioning? Let's say, what was your positioning a quarter ago and what is your positioning now? And given that we've seen more like a shakeout in the market, if I may use the word Hindi word samudra manthan, we've seen a manthan in the market. Where are you picking your spots?
So see, I think the China reopening trade is playing a big factor in everybody's thinking, especially foreign investors, because China is definitely valuations are very attractive. Same thing in Taiwan, Korea, and some of the other Asian markets. And in general, I would say emerging markets are looking good compared to the developed markets, particularly the US, on valuations. So we are in an environment where value is still likely to outperform growth. And there is a lot of value in the rest of the world compared to India. India, there is value obviously in pockets, but there is more value to be found in the other markets. So foreign investors with the reopening of China are clearly looking to add back to China. Of course, there is a fear and that a risk of China has gone up because of what has happened politically as well as economically and with COVID. So India is obviously, from a long-term perspective, the companies are still, global companies are still seeing India as a better source of growth. And also they want to add more and more capacity in India. So I think you can't ignore India. Yes, the valuations are high, but the incremental flows and some rotation out of India is definitely happening, and we are also finding that there is, more value in China at the moment.
Punita, hi, morning. When we're looking very closely at the budget, there seems to be a lot of thrust this time expected, in particular on the infrastructure space, on the rails, roads, ports, as well as on what could potentially emerge as a big booster for the defense space as a whole. What is it that you're working with in terms of expectations, and do you believe that the capex theme should be a strong play in the portfolio?
Yes, I absolutely think so. I mean, first of all, in a higher inflation environment, infrastructure and real estate are generally considered good assets to be in. In fact, on some of the investment committees that I chair of other funds, we have been looking to add infrastructure funds, and I'm talking global, I'm not talking India, and add to real estate funds as well. So, and I think globally, that is a trend that plays out well. And in India in particular, given that a lot of the global companies want to add more capacity, there is going to be need for more capex. And so I think both the inflation environment and the fact that both the private sector and perhaps the government will continue to focus on infrastructure, capex related companies should benefit from these trends. These are longer term trends. Of course, as you know, capex doesn't happen overnight, and these are long gestation projects. And when this kind of a scenario plays out, obviously financials also benefit because credit growth also picks up. So I think as a result, I think both the capex sensitives, infrastructure, real estate, as well as financials should see growth opportunities.
So that's how you want to play the capex cycle. But Punita, good morning. Nantar also joining in. You talk about how you want to add names from around the world, and it's a theme that you're big on. But the other way to play this is through banks. Last year, what we saw was the comeback of the banking stocks, right? It was certainly not like that at the start of the year, but look at the strong way the banks ended the year. Going into the big event of Union Budget, there's very high expectations. Indian banks have never looked better. You've got the PSU banks also, which are now looking better. The valuations are going up. What's your strategy here, especially ahead of budget?
So, I mean, we are definitely overweight banks. And of course, there could be some rotation from the higher valued banks. I mean, we have a lot of banks to choose from to invest in India. So there is a big disparity always in valuations. And that links itself to obviously quality and confidence. And so one definitely can, there might be rotation from, banks, one bank to the other, but banking as a space looks good. Of course, there is, if you look at estimates, the credit growth has been strong, but some are forecasting while credit growth to still be strong, but slower than what it has been. A lot depends on what also happens in the budget, also what happens with the Fed meet. But I think, as I said, that if in general, the longer term trends support capex in India. We are going to get capacity constrained pretty quickly if a lot of the companies, particularly the multinationals, are continuing to expand in India. And we've not had that kind of aggressive expansion in a while. And a lot of companies are reaching capacity utilization rates that need them to rethink their capacity expansion plans. So I think definitely we are going to see that regardless of what happens in the budget, because that's a longer term trend that is required for India to keep growing.
There's a lot of speculation in the market whether or not there's going to be any tampering with rate neutralization, or tenure or quantum or whatever it may be. Just wanted to understand what is your own thought on an LTCG or STCG, etc., and whether or not there is any case considering tax collections are buoyant, and we've seen in the past as to how 2022 India has been the favor of most markets across the globe, and we've been an outperformer, barring, of course, the month-to-date aberration that we've had.
Well, I don't see particular need for any change in the tax regime, other than the fact that, globally, as I mentioned, US and some of the other markets, the rates are a lot higher than what they are in India. So if the government has some plans to invest somewhere else and they need to garner more resources, then this is a place where they could easily think of, given that we are below a lot of global markets in terms of our capital gains rates. So that's the only reason I would see them wanting to do that, is to use the money for some other projects or other allocations in the budget.
Valuations when it comes to the IT space, how do you see those emerging? How have you read into the kind of quarterly numbers as well as the kind of commentary that some of the IT majors have doled out this quarter?
I mean, the commentary has been good, positive, more positive than I had expected. And, it's whenever the inflation is high and costs in the US are really quite high. In fact, I'm hearing that even not just technology, in many, many areas, people are outsourcing more to India, even in the, simple thing like accounting. There's a lot of accounting and financial functions that are being outsourced to India because the wages have really gone up there. And similarly for technology, there are layoffs that are happening globally, and to the extent that they can outsource some of those functions to India at cheaper rates, that trend might continue. Valuations of IT stocks have obviously over the last year corrected to some extent. Now, IT, which was generally considered in the past a growth sector, I think now is more in the value camp, because the dividend yields, these companies are generating a lot of cash. Dividend yields are pretty good. There's stock buybacks that happen as well. And the growth trends are, stable. They're not the high growth companies that they were 10 years ago, but the growth rates are stable and decent, and the secular trend is still there. So, as I said, I think at the moment, the focus has been more to be in names that are attractively valued, because there is risk. There are still risks in the markets globally, and so one shouldn't be really rushing to buy growth names. And technology is kind of an interesting, IT is an interesting sector that has stable growth and decent valuations at the moment. So I think one should always have some exposure to Indian IT.
Punita, that's all the time we have for today. Many thanks for joining us. This is, of course, a big week from earnings to